This video covers Chapter 6 notes. Chapter 6 was titled Variable Costing and Segment Reporting Tools for Management. So our first learning objective in Chapter 6 was to explain how variable costing differs from absorption costing, and also to come up with unit product costs under each of those costing methods. So a couple of assumptions to keep in mind as we work through Chapter 6. We're going to assume for purposes of our different costing methods that the actual number of units produced is always going to be the allocation base for assigning actual fixed overhead costs. So we're not worrying about any capacity type issues there. And then second, we're going to assume that the variable cost per unit and the total fixed costs are going to stay constant per period. So this is in line with the cost behavior assumptions that we've been making really all semester so far. So another quick refresher from Chapter 1 here. Product costs for our purposes, also known as inventoriable costs, are any costs associated with getting the product finished and ready to sell. Remember, those costs flow through the inventory accounts, and so they only hit the income statement when the products are actually sold. Period costs, on the other hand, were any costs that were not associated with getting that product done and ready to sell. So for us, that was primarily our general selling and admin expenses. And note that those costs were expensed, so they hit the income statement in the period in which they were incurred. So they weren't tied to any timing as far as sales of goods. So if we look at the right-hand side here under absorption costing, that's really the costing method we've been assuming all along this semester. It treats as a product cost all costs of manufacturing, variable and fixed. So all the direct materials, all the direct labor, all the variable overhead, and then all that fixed overhead. It treated as a period cost everything else, all those selling and admin expenses, regardless of behavior, so variable and fixed. On the other hand, variable costing treats as a product cost only those variable costs of production. So direct materials, direct labor, and then the variable portion of the manufacturing overhead. On the other hand, everything else is treated as a period cost, so that would now include all the fixed manufacturing overhead. So really the sole difference between the two costing methods hinges on how we treat that fixed overhead. Under absorption, or full costing, as we sometimes call it, that fixed overhead is in fact included as a product cost, so it moves through inventory. Under variable costing, it's treated as a period cost, so it would be expensed in that period in which it's incurred. I did include the Socrative questions in here, so you're welcome to work through those as you go through the notes. I will ask you to fill out just a little quick assignment on Canvas to indicate you've done those. So the first one up here, which of those costing methods would produce the highest values for work in process and finished goods inventories? Think about that for a second, pause if you need to, and then we'll hit the answer here. So the best answer is A, absorption costing. So remember, the only difference between the two costing methods is how we treat that fixed overhead. Under absorption costing, it's included as part of the product cost or the inventoriable cost. So all else equal, that would make inventory values higher under absorption costing as compared to variable costing, where that fixed overhead's not included in inventory. Well, what about external reporting? So US GAAP and the International Financial Reporting Standards do require firms to use absorption costing for external reports. So given that, a lot of companies do use it for internal reporting as well, rather than sort of keeping two sets of books or two types of reporting. So just for consistency purposes, to eliminate internal confusion, firms might use absorption costing for everything. One other thing to keep in mind related to that external reporting is that absorption costing really does fit more naturally with our matching principle from Financial Accounting Principles. So if you recall, that principle just says we should try to match costs in the period in which they're incurred to generate certain revenues, and absorption costing fits that nicely, right? The product cost flowing through inventory only being recognized on the income statement when those goods that they were incurred to produce are in fact sold. Variable costing, on the other hand, treats those fixed manufacturing costs as capacity costs and sort of assumes they'll be incurred even if nothing is produced. And that might be a very reasonable assumption particularly in some automated production processes where things are machine intensive and all these committed fixed costs really can't be changed regardless of sort of production levels. So let's take a look at some unit cost computations, and we're going to use this Harvey example to kind of carry through for a bunch of these concepts. So let's say Harvey Company makes a single product, and you've got the following information available. Every year they produce 25,000 units of that thing, whatever it is they're making. They incur variable cost per unit of $10 related to direct materials, direct labor, and variable overhead. They also incur $3 per unit in variable selling and admin expenses. And then at a fixed cost level, we've got fixed overhead of $150,000 per year and fixed selling and admin expenses of $100,000 per year. So if we want to derive a unit product cost under both absorption costing and variable costing, just really need to keep in mind the sole difference in those costing methods and how we treat that fixed overhead. So if we look first at absorption costing, again, also known as full costing, we're going to include all of those things we've been traditionally considering product costs. So all the direct materials, all the direct labor, and all the overhead, variable and fixed. So with that in mind, we've got the $10 in variable production costs, as well as $6 in the fixed overhead. That's the $150,000 per year divided by the 25,000 units we produce each year, for a total product cost of $16 per unit under absorption costing. Under variable costing, again, the only difference is that fixed overhead would be treated as a period cost, expensed entirely in the period in which it's incurred, so it's not going to be attached to the product. So the unit cost under variable costing is just $10, the variable costs of production, that direct materials, direct labor, and that variable overhead. Learning objective 2 was to prepare income statements using both costing methods. So because the costing methods lead to differences in inventory valuation, they can certainly lead to differences in net income as well, given that those inventory values flow through cost of goods sold at some point. So let's assume a couple more things about Harvey here and continue that example. Let's say that they sold 20,000 units here in year 1 at a price of $30 each. Keep in mind they produced 25,000. Let's also assume that there's no beginning inventory. Let's look at the difference in income using both of those costing methods, absorption and variable. Under variable costing, we would typically use the contribution format income statement. Since it's grouping things by cost behavior, it's a more natural fit there. So at the top line, we can see sales of 600,000, the 20,000 units sold times 30 bucks. Under our variable expenses, we've got the variable cost of goods sold. So the 20,000 units we sold times that unit product cost under variable costing, just that $10 reflecting the variable cost of production. We also had the variable selling and admin, total of 60,000. That gets us down here to a contribution margin of 340,000. Now below the line, we're deducting all the fixed costs. We said under variable costing, all of that fixed overhead should be expensed the same period in which it's incurred. So we're deducting 150,000, the total fixed overhead, and 100,000 for that selling and admin, and we end up with net income of 90,000. If we take a look at an income statement using absorption costing, typically we'd use the traditional format there. So the top line sales, that's no different, 600,000. Now the cost of goods sold, the same 20,000 units we sold, but at a unit product cost of $16 under absorption costing. That leaves us with a gross margin of 280,000. Then we deduct all of our selling and admin expenses, variable and fixed, and we see a total net income of 120,000 on the bottom line. Now the difference of 30,000, remember variable costing here, net income of 90,000, now absorption costing 120. That difference of 30,000 is attributable entirely to that treatment of fixed overhead. Under absorption costing, we have deferred, or trapped if you will, $30,000 in fixed overhead cost in inventory related to those unsold units that were produced. So that generates the entire difference in income between the two costing methods. Under variable costing, that full $150,000 in fixed overhead was expensed, so it came out of income. Under absorption costing, only $120,000 of that $150,000 was taken out through cost of goods sold. So the rest is trapped or deferred in inventory, which leads us with a bit higher income under absorption costing. Our third learning objective was to be able to sort of reconcile those formally and explain why they're different. We've taken a big step in that direction already. So if we look at the two top to bottom here, again, under absorption costing, we've got cost of goods sold, $200,000 related to those variable production costs, and $120,000 related to that fixed overhead. Again, only the fixed overhead related to the units that were sold, not produced. Conversely, in ending inventory, we've got $50,000 in variable production costs and that $30,000 in fixed overhead. Under variable costing, we had cost of goods sold at $200,000, all the variable production costs, $50,000 of those variable production costs sitting in ending inventory, and that full $150,000 in fixed overhead treated as a period expense. So again, the entire difference, just how we treat that fixed overhead. We've deferred some overhead costs in inventory under absorption costing. Those have all hit the income statement under variable costing. So if we reconcile that top to bottom, it's just a couple quick steps to prove that out. Variable costing net income here was $90,000. We would add to that the fixed overhead costs that were deferred in inventory, again, aka trapped in inventory, $30,000, to get to our absorption costing net income of $120,000. Conversely, if we sort of peek ahead to the next few slides, we would also deduct here any fixed overhead released from inventory under absorption costing if we had sold more units than we'd produced rather than having produced more than we sold like we did in this first example. So the timing is what's critical there. Let's extend that Harpy example out to year 2 then. So let's assume in year 2 they've produced the same 25,000 units as year 1, but now they've sold 30,000. So with that beginning inventory of 5,000, they've cleared all those out, and they've sold everything that was made this period. Let's assume the same sales price is in effect. Let's assume the same cost structure otherwise is in place as well. So same unit cost as year 1. The absorption costing was the $16, the full manufacturing cost. And under variable costing, it was the $10 related to just those variable costs of production. So we look at that income statement for year 2 under variable costing. We see sales of $900,000 based on those 30,000 units sold. Again, the variable expenses are the variable cost of goods sold at the $10 unit cost. The variable selling and admin expenses to get us the contribution margin of $510. We're still expensing all of that fixed overhead incurred, all the fixed selling and admin as well, and we end up with a net income of $260. Now under absorption costing here in year 2, sales again no different from variable costing, $900,000. The cost of goods sold, 30,000 units times that full $16 unit cost, again representing the full cost of production, leaves us with gross margin of $420,000. Then we'll take out the selling and admin expenses, and that leaves us with net income of $230. So now the difference is the other direction, right? Variable costing net income $260, absorption costing net income $230, related entirely to the fact that here in year 2, we're releasing from inventory $30,000 in fixed overhead that was previously deferred in inventory. So again, we can reconcile the difference here. If we start with our variable costing net income of $260,000, we'll deduct from that now the fixed overhead released from inventory under absorption costing, so the 5,000 units times $6, or $30,000 total, and that leaves us with our absorption costing net income of $230,000. It's important to note here that over this 2-year period, we end up with the same total income under both costing methods. So it really does boil down to timing. Under absorption costing, remember we had 120,000 income in period 1 versus 90 in variable costing. And then in period 2 was 230,000 under absorption costing versus the 260 under variable costing. So it's a matter of shifting income from one period to another, given those differences in production and sales levels. So let's try another question here. A reason why absorption costing income statements could in some cases be considered difficult to interpret, or at least potentially misleading to some, is that what? A, B, C, or D here? Give that a thought. Pause this if you need to, and then again we'll hit the answer. So the answer there is B. They shift portions of fixed overhead from period to period according to changing levels of inventories. Right? So it's not necessarily a matching of when the cost is incurred. It's more related to the timing of the sale of the units that are produced based on those costs, essentially. One more question here. When unit sales are constant, but the number of units produced fluctuates, everything else remains the same, net income under variable costing will do what? Again, give this a quick pause, give it a thought, and then come back for the answer. So the answer there is B, to remain constant. Yeah, remember under variable costing, all that fixed overhead gets expensed in the period in which it's incurred. So the timing of that production versus sales differences doesn't matter. So to summarize a few key insights here, it really depends on the relationship between the number of units produced and the number of units sold as far as which income will be higher, absorption costing or variable costing. If the units produced is equal to the units sold, that means we haven't had any change in inventory during the period. In that case, the absorption costing net income and the variable costing net income will be identical. Okay, nothing's being released or deferred in inventory. If the units produced is greater than the units sold, that means we're increasing inventory. So income under absorption costing will be higher than it is under variable costing because we'll be deferring some of that fixed overhead cost in inventory. And finally, if the units produced are less than the units sold, that means we're decreasing inventory levels, and net income under absorption costing will be lower than it is under variable costing because we'll be releasing from inventory those fixed overhead costs that were previously deferred. When we release those costs from inventory, pushes cost of goods sold up, net income down, and that leaves us with net income, again, lower under absorption costing than under variable costing. Just a couple more things for us to keep in mind related to these two costing methods. Variable costing, as we know, categorizes costs as variable and fixed, so it's certainly an easier fit to use that contribution format income statement for CVP analysis. And then as far as absorption costing goes, because it assigns that fixed overhead to the units produced and becomes an inventoriable cost, a portion of that overhead cost does sit in inventory if we have any kind of inventory level period. So the potential result, as we've somewhat demonstrated, is positive net income if the number of units sold is less than that break-even point that we calculated in Chapter 5. The variable costing income, we also note, is only affected by changes in unit sales, not by the number of units produced, because again, it's expensing all that fixed overhead in the period in which it's incurred. So as a general rule, if sales go up, net income goes up, and vice versa. But absorption costing, on the other hand, is influenced by changes in both the volume of sales and the volume of production. So net income really could be increased just by producing more units, even if those units are not sold. In other words, we're saying we could decrease the unit cost under absorption costing by creating or producing more units for that fixed overhead to be spread out over. So essentially, we could manipulate our income measure under absorption costing just by changing the level of production. So that's something for stakeholders to be aware of if they're sort of looking at a firm's income statement. A variable costing does correctly identify the additional or incremental variable cost incurred to make one extra unit. So under our Harvey example, that was the $10 per unit in materials, labor, and variable overhead. So it really emphasizes the impact of the total fixed costs on profits as well. But under absorption costing, since we're assigning that fixed overhead again to the units produced, it really gives the impression that that fixed overhead varies with some kind of change in production levels. But really it doesn't. And so this is essentially saying that we're creating this situation on paper where it looks like that fixed production cost is changing if we have differing production levels from one period to the next. The only point being there, it might lead some of our decision makers potentially astray or paint a less than ideal picture of what our cost movement really is as a function of that change in production. Learning objective 4 was to shift gears here and prepare a segmented income statement that differentiates some traceable fixed costs from common fixed costs, and then use it to make some decisions within the firm. So for our purposes, a segment is really any part or even an activity within an organization about which we want some kind of cost, revenue, or profit data. So it might be an individual store, a service center, a sales territory, a division, a product line, really, again, almost any kind of thing about which we want some kind of profitability data. US GAAP and the International Financial Reporting Standards do require publicly traded companies to include segmented financial data in their annual reports. So companies do have to put those things together using the same methods that are used for internal segmented reports. That hopefully motivates managers to avoid using the contribution approach for internal reporting purposes, because if they did, they'd have to do two things. Right? They'd have to share that sensitive information with the public, so anyone who wanted to see it, which wouldn't be good. We're trying to keep that from competitors, most likely. And also would require us to reconcile those reports with all the applicable rules for consolidated reporting purposes. So again, just generally speaking, these things aren't quite as separate within an organization as we might sort of think about them on a theoretical level. I took a look at Amazon's current segmented information, and I always find it interesting they segment their business into North America, which is all their North American retail sales, so to speak, international, and then their web services. And their web services are actually their most profitable segment. There's tons of stuff out there that runs on Amazon Web Services, and that's really where they're making a pretty good chunk of their money these days. So a couple of things for us to think about as we look at segmented income statements. There's really two keys to putting these things together. We should use a contribution format for that income statement because we want to be able to separate fixed from variable cost and come up with a contribution margin within the segment first. Then we want to make sure we can separate traceable fixed costs from common fixed costs so that we can calculate the segment margin of a particular segment. So that's a new measure for us here in Chapter 6. Now, traceable fixed costs come about because of the existence of a particular segment, and all things equal, they disappear if that segment itself went away. So just a couple quick examples, the salary of the Fritos product manager at Pepsi, we'd say is a traceable fixed cost of that Fritos business segment. If we decide tomorrow not to make Fritos, we don't have a Fritos product manager, so their salary traceable to that segment. Similarly, the maintenance cost for the building in which Boeing makes 747s is a traceable cost of that 747 business segment. If we stop making that particular type of aircraft, we won't have any maintenance costs for that facility, presumably. So answer this one real quick if you would. If a cost is traceable to a particular segment in a manufacturing firm, does that mean the cost must be also considered a direct cost with respect to the production of that segment's product or products? Give this a pause and a thought and then come back for the answer. So the answer there is no. Traceability may have nothing to do with whether that's direct or indirect with respect to something within that segment. And this relates to that discussion we had way back when about direct and indirect costs and those definitions potentially differing when we move one level of analysis to the next. In other words, we could have a cost that was traceable to a particular segment, like in our previous example with Boeing, that once we get into that segment, that maintenance cost is probably an indirect cost, in fact, of the production of those 747s. So traceability does not automatically make something direct with respect to the products and services provided within that segment. Common fixed costs, on the other hand, come about because of the overall operation of the company, and they would not go away if one particular segment were eliminated. So for example, the salary of the CEO of General Motors, that's a common fixed cost of the different GM divisions. Similarly, the cost of heating a grocery store, so Safeway, Kroger, Publix, whatever, is a common fixed cost of the various departments. If Kroger decides tomorrow, or Publix, that they don't want to sell deli items anymore, they get rid of the deli, the rest of the store still has to be heated, right? So we'd say that that heating cost is a common fixed cost of all the different departments. Using a university example, we might think about a common fixed cost of colleges being the president's salary, right? So President Clemens, if tomorrow Clemson decides that the College of Business is going to cease to exist, President Clemens isn't going to be out of a job, right? So his salary would just become a common fixed cost of the remaining colleges, arts and sciences, engineering, whatever else. It's also important for us to keep in mind that the traceable fixed costs of one segment might in fact be a common fixed cost of another segment. So for example, airlines pay landing fees to land at particular airports. Those landing fees are traceable to a particular flight, but they're not traceable to any individual customers or type of customers within each flight. So again, it's a level of analysis question, right? In that flight example, we can't trace the landing fee to first class, to business class, to passenger X, passenger Y, anything like that. It doesn't mean that firms don't ever allocate costs to different types of customers or types of products or whatever. It just means that it's not traceable. You can't attribute it solely to that particular type of customer in this case. So that new measure for us here in Chapter 6, the segment margin, is going to be found by taking the contribution margin of the segment, which again was just sales minus variable expenses, and then deducting just the traceable fixed costs of that particular segment. We would say that the segment margin is the best indicator of the potential profitability of that individual segment. And as a general rule for us, we'll say that if a segment has a positive segment margin, or even at zero, that they're contributing something positive to the company's overall bottom line, and all things equal, they should stick around. We shouldn't discontinue them. So let's look at an example here with Weber Inc. Let's say they've got two divisions, computers and TVs. If we put together a contribution margin format income statement for just the television division, again, we're starting with sales. We're taking that through to contribution margin by deducting all the variable expenses. And then now on a segmented basis, we're going to take out the traceable fixed expenses. That's only those fixed expenses that are attributable strictly to that TV division. And that'll leave us with a division or segment margin then now of $60,000. Contribution margin of $150 minus those traceable fixed of $90. So we're saying that the TV division contributes, if you will, $60,000 in segment margin to the company's overall bottom line. We also had that computer segment, so if we slap those in here real quick, let's say that had contribution margin of $120, traceable fixed of $80, and then a division margin of $40. So again, it's contributing something positive to the company's overall bottom line. Now let's also assume that Weber has $25,000 in common fixed expenses. If we deduct those from the total segment margin across all segments, that'll give us the company's overall net income. The point we want to make first here is that these common fixed expenses shouldn't really be allocated to the individual divisions. Those things would presumably stay around even if one of the divisions went away, so it would just have to reallocate if one of those did disappear. We don't want to hold managers accountable, generally speaking, for things that are outside their control. And these common fixed expenses, by definition, aren't controllable by either of these segment managers. Once we put together a contribution format segmented income statement, we can use that to make any of our keep or drop type decisions and to do some break-even analysis. And that took us to learning objective 5, was to calculate company-wide and segment break-even points. And really we did this in chapter 5 with multiple products, and it's generally the same idea, which is nice. So looking at our Weber example again, let's first calculate the company-wide break-even point. So let's do that in terms of sales dollars. We're going to take all the fixed expenses for the company. So that's all of the traceable fixed expenses of the individual segments, plus the common fixed expenses. And we're going to divide that by the overall company CM ratio. That overall CM ratio would be the overall contribution margin, again across all segments, divided by that overall sales for the company as a whole. Okay, so in this case, that's your 54%. So total fixed expenses, both traceable and common, divided by that overall CM ratio, gives us a company-wide break-even point of 361,000 and some change there. Now, on the other hand, if we want to calculate break-even point for each individual segment, take a slightly different approach here. It's still our fixed expenses divided by CM ratio, so that didn't change. Just have to be careful about which expenses we include and which CM ratio we use. If we look at the television segment first, we'll take their traceable fixed expenses only, so the 90,000, divided by the CM ratio of just that segment individually. In the case of TV, that was 50%. The total contribution margin divided by total sales. Same thing for computer. Their segment break-even point will be their traceable fixed expenses attributable just to that segment, divided by the CM ratio just in that segment, which in computer's case, 60%, 80,000 in traceable fixed expenses, so a break-even point of 133 and change. Now you may be asking, why don't these individual segment-wide break-even points add up to the company as a whole? It's because we're not accounting at the segment level for those common fixed expenses that the company as a whole does have to take care of. So that'll drive your difference there if you're wondering. Then again, just notice that we're not allocating those common fixed expenses to the individual segments for purposes of that analysis for break-even. We don't want to saddle these individual segments with costs that they can't control. One other note here, all the costs assigned to a segment really should include anything attributable to that segment from the entire value chain. And that's a term you may have heard in a marketing or operations class. Business functions making up the value chain really do include everything from R&D, research and development, all the way through customer service. So the only point we want to make here is that all these types of things should be attributed to that individual segment as appropriate. A couple pitfalls of us to make sure we're careful of. There may be a failure to trace costs directly that could result in inappropriate methods of allocating costs. So what we're saying there is that costs that can be traced directly to specific segments shouldn't be allocated to other segments. Right? We should really focus on saying, what drives this cost? Can we attribute it to one particular segment? If so, consider that a traceable fixed cost. If not, just lump it in with those common fixed costs, but don't allocate it to the individual segments. You may also use an inappropriate allocation base here. So some companies do allocate costs to segments using some bases that are generally arbitrary, right? Based on some kind of total sales or something that isn't really indicative of their usage of that cost or that underlying resource. So if costs are allocated, they should be allocated to segments only when that allocation base actually drives the cost being allocated. So if it's something to do with factory space, for example, how much space does each segment occupy? We could allocate based on that, based on their total usage, in other words. So answer this question here. Allocating common fixed expenses then to business segments does what? Again, give this a pause if you'd like and then come back for the answer. The answer there is D. It may cause managers to erroneously discontinue business segments. Now that's somewhat of the extreme case, but even absent that, it might distort the potential profitability of any individual segment and lead to decisions that are at least less than optimal. So to wrap this up here, common costs shouldn't be arbitrarily allocated to segments based on this idea that, well, someone's got to cover the common costs, right? Well, shouldn't do that for at least two reasons. First, and we've hinted at this a couple times now, it might make a profitable segment appear to be unprofitable. If we're just saddling them with these top of the house costs that they have no control over, we might be undermining the contribution they really make to the company's overall profitability. And then second, allocating those common fixed costs really does force managers to be held accountable for things they might not be able to control at all. Again, these top of the house costs that are shared amongst everyone, individual segment managers can't make decisions to change those, generally speaking. So if we're holding managers accountable for that, it's not going to work out very well for evaluation purposes. And for that matter, it's probably not going to work out very well for satisfaction and morale. Right? If you're a manager, you don't want to be held accountable for things that you have absolutely no control over. So that brings us to the end of the Chapter 6 notes. Please do back up and review any portions you want to see again, and then reach out with any questions you have.